Good afternoon and welcome. My name is Bill Woodruff. Today I'll be reviewing my thoughts on global financial markets with a specific look at July of 2020. Share a few words for compliance purposes. This call is for informational purposes only and may be recorded. Statements made during this call are the opinions of the speaker and are subject to risk and uncertainties, some of which are significant in scope and by their very nature beyond the control of wealth factor. There can be no assurance that such statements will prove to be accurate, and actual results and future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. So for those of you who are less familiar with me, I founded Wealth Factor in 2017, largely disenchanted with the average investment advice service offering in the industry and based on the belief that I could build a better way. I have a diverse background in investing, both in small businesses, a former firm that I founded, operated, including the launch and management of a mutual fund. And I've also spent time as a managing director at the public company Fortress Investment Group. Wealth Factor is a Lake Oswego-based investment advisor. We focus on providing efficient, customized solutions to our investors. Most of what we do is based on indices. We manage portfolios and provide investment advice through accounts held in our clients' names at independent third-party custodians. And we charge a 0.35% fee on assets in which we're responsible for managing. A quick review of how Wealth Factor views the world philosophically. We have what we call our RiskSmart approach to investing, and there are three core components for that. First is being portfolio smart, which is largely a reference to the structure in which we provide investment advice and is really about what you avoid. We believe that most of the time, if not all the time, we should avoid picking and timing of investing at every level, the individual security sector, overall global exposures, etc. I also believe very strongly that layers of management and complexity almost always hurt the end consumer or the average investor. Fees, so there's a variety of efficient element components to being what we call fee smart. It starts with our fee, which is really less than a third of what I see in terms of industry average, and then rooting what we do largely in evidence-based or index-based investing further drives efficiency in, again, being fee smart. And lastly is tax efficiency, or what we call being tax smart, and with a focus and a background in systems. We offer a service which is called direct indexing. And what that is effectively taking an index and replicating it using individual securities, which gives us the opportunity to specifically in taxable portfolios, really manage for tax, which is something I think we're going to see the industry really shift to over the next 10 years. So before I jump into July, just kind of a re-summary. We've had a lot of volatility in 2020. First quarter, obviously the coronavirus was a major note and not something that any investor could have really anticipated. And then even the impact and the potential for complete shutdown of economic activity. That was obviously something that was exogenous and unpredictable. And then almost equally so was the swift action by the Federal Reserve Bank and the federal government. As you reflect back on that swift action, you could link that to what was probably a slow reaction in the global financial crisis of 2008. While the Fed, and to a lesser extent the federal government, did act, it took a significant amount of time for them to organize and put into place their various different programs to support the economy through the financial crisis. And so lots of, I think the real themes for this year was exogenous event driven by a pandemic, and then, very swift reaction by the Fed, and really, as well as global central banks, not just the Fed, and then the US government and other governments. And so we've seen we saw a very, very quick descent in asset prices across the board as we faced, shutdown from an economic activity perspective. And what does that mean? And we've seen a V-shaped recovery, largely, again, driven by very, very quick action. So I'm going to spend, my goal in these is to be as brief as I can, focus on quality over quantity, and then also tilt to what I think is the proper way to think about investing is not get too granular or too detailed about what happened yesterday in the market or what even happened in July in the market. And so the goal, even though the cadence of these calls is monthly, the orientation and perspective, I'll try to really focus on longer run thinking. So today we'll go through some thoughts on valuation. That's a big topic. It has been a big topic, and the media's really picked up on that. Some long run perspective relative to the overall markets. And then, I think it's really easy to get really equity centric from an investment perspective and investment advice perspective. And so I'll spend a little bit of time talking about interest rates and inflation. So this graph is a graph going back to 95 all the way to current. Apologies, it actually only goes through June 30th. We see a little bit of a stretch up between June 30th and July from here, but this is plenty of data to talk about this concept. So this is the PE ratio, the price relative to the earnings on a forward or estimated basis for the S&P 500, or what really are the largest, generally the largest 500 companies in the S&P. So we can, and then it's the middle dotted line is a 25-year average, and then there's plus or minus 1 standard deviation for perspective. We can see that based on forward PEs, we are above the 1-year standard deviation mark or line. A couple thoughts here. One, valuations have had, especially on a short run basis, very limited predictive value. So as you hear in the media or think about, man, stocks are high or the valuations from a PE perspective aren't interesting or attractive, I would caution you from drawing the conclusion that I shouldn't own stocks because of valuation. The second thing that I think is a little bit more nuanced and a little bit harder to identify here is if we go back, we have a period historically where we saw valuations significantly higher for a fairly long period of time, and that's really that buildup of the tech bubble. So this really speaks to that same concept of valuations not being necessarily useful or predictive. In that, if we kind of looked over to 1997, we have that 20 plus PE multiple. And it stayed that way really all the way through 2001, 2002. It's also worth noting that just like most things in financial markets, economies, et cetera, if you're using a forward PE, it's by its very nature an estimate. Trying to predict anything in our world is probably an exercise that really has, again, a limited amount of benefit. So I referenced this, and this is a more complicated graph, but it supports the simple concept that I just shared, that the idea that PEs or valuations have limited, if not in some cases, almost no predictive value in the short run. And so we have an R squared figure on the left. And there's a lot, this is basically mapping 1-year returns after a certain PE measurement or data point. And so all those little gray dots are all of the data points. And then they're fitting through a regression analysis, what is the R squared? And to define R squared, you're basically saying if you have 100% R squared, there's a lot of meaning there. And as that R squared gets close to zero, it would suggest there's not a lot of meaning. And so if we're looking at 1 year forward returns, a 9% R squared would suggest, okay, we have a high PE today. That's nearly meaningless in regards to what the future 12 months are going to yield from a change in equity asset prices, at least based on historical experience. And then the second side, the right side, shows it over the following 5 years. And as you go out over longer periods of time, data tightens. There's lots of volatility in the short run in equities historically, but over long periods of time, you see a significant tightening. And so in this analysis, you do see some relationship between valuations and returns to some degree. One last point I'll make on valuations is conceptually, most things in investing are relative to other choices. So if we're thinking about equities relative to bonds or safe bonds or relative to cash, if we think about the data that we're looking at here and we go back and we look at what was the average yield for safe fixed income over this time period, and this is the same time period that the last graph is goes back all the way to 1995. And I don't know off the top of my head what the average 10-year treasury yield was over that time period, but there's good stretches where you could get 5 or 6% from just owning a treasury and taking no theoretic credit risk. And so if we look at today and say, PEs are, relative to that time period, last 25 years, historically above average, there may actually be a basis for that relative to our choices, with the 10-year treasury today being, I think, somewhere around 50 basis points. So I'll transition just to kind of that same, kind of close off my equity thoughts with that concept visually about volatility in equity prices or returns in the short run versus an increased consistency. Not perfectly consistent. There's always uncertainty in equity markets, but as you go out longer time frames, a much narrow potential outcome, and this is always subject to investor and investment mistakes in terms of decision making. Left to our own devices, we're going to be prone to selling when we're afraid, and we're not likely to buy, and we're more likely to buy when we feel comfortable. When in practical reality, the opposite is probably more useful in terms of investment decision making. So what this is a rolling analysis for equity returns going back very, very far, 70 years approximately. Ends up being a lot of data points if you're doing rolling returns, which gives us more information because it's not just simply looking at the calendar year from January through December, creating a rolling period for every, and in this case, 1, 5, 10, and 20-year stretch. And so what you see here is through this exercise, and you see it visually, is in a 1-year period. And just for I don't think there's a whole lot of use in looking at bond portfolio blends today, because over this period, bonds on average had a 5.9% return, and bonds by their very nature, the majority when held to maturity, if not all of the return, is driven by the interest rate, whereas today interest rates are near zero. So focusing, I think, just on the equity example here, you can see in 1 year, there's years that are up 47 and years down 39. But you go out just as far as a 10-year rolling period analysis, and sure, there's the potential for negative returns. And there are certainly scenarios where equity markets could have a more meaningful than a -1 annualized return over a 10-year stretch. But there's also 19 on the upper bound of that. And obviously the average over this entire stretch is 11.3% from an equity return. So the point isn't to try to be predictive, but more simply go through that exercise of reorienting how we think from 1-year time horizons to 5 or 10, which in my opinion, or longer, is the proper way to think about making what is an investment into global or US or non-US or however you want to, whatever exposures, making that is an investment. It's not a trading strategy. And unless you're a hedge fund or a proprietary trader, and that's what you do for a living, I would, and even then I would argue probably against it. It doesn't make any sense to be thinking about the things that are investments in shorter term time horizons. So transitioning to interest rates and inflation here, is the environment of, all-time low levels of yield. So I mentioned 10-year Treasury as of July 31st, which is the blue line. We saw 0.55%, which is very close to, I think it's a historic month-end low. It might not be an all-time exact low, but that's very close to zero yields. We think about it from just a human nature perspective. You think in your mind that there's a zero band, rates can't go below zero. Well, that, other countries and their sovereign debt have disproven that. Japan was one of the earliest and really have had prolonged periods of negative nominal interest rates. And so the other element and the critical element to safe fixed income or interest rate risk or those topics is the level of inflation. And there's very much, as you can visually see, or oftentimes a link or a correlation between inflation and the nominal yield. As I've studied interest rates closely over my career, I think about the level of interest rates as having two primary drivers, inflation being obviously a significant one, as you see in this chart, and inflation and many things is a relative to other countries and other assets and macro elements to markets and economies. And so, the other one being economic growth. So we have very low interest rates, and that's a function of market expectation that we aren't likely to see inflation, and we're not likely to see, or we're currently measuring inflation at a fairly low level, and we're not likely to see economic growth. And so interest rates, I've seen for a decade, and I was part of this group, and actually it was even more, a little bit more than a decade, saw the decline from 1981 to, as early as 2006, 2010, that time frame, and look at that graph and say, oh, well, interest rates have fallen so much they have to go up. Well, it's 12 years later, and interest rates have continued to decline. And so I look at that and say, okay, we're at 0.55. And through my experience in attempting to forecast the direction of interest rates, both in investment strategy and just personally from a mental exercise perspective, I know better. I know that it will require increases in economic growth or increases in inflation for the nominal yield, market yields to rise. And without that, I absolutely believe that we could see a prolonged period of very low yields, which provides a unique set of challenges, and it's also fairly supportive, again, of valuations and equity markets being higher. So that concludes all of my prepared thoughts.